Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. Duncan Rowland is a CEO and founder of a company by the name of migrations.ml. And he recently wrote an opinion piece in the Globe and Mail that I found really fascinating. It was about technology, about entrepreneurship, and also about the capital gains tax. And it was titled, actually, Opinion. Calm down. The sky isn't going to fall with a capital gains tax hike. And I was intrigued by that. So I had to reach out to him and find out, is this entrepreneur actually serious that the capital gains tax isn't going to destroy entrepreneurship like so many people have claimed? Because that's what his argument is. And so I thought it'd be kind of interesting to check in. So Duncan Rowland, welcome to the show, sir.
Thanks very much. Thanks for having me.
So what motivated you to write this opinion piece? You're an entrepreneur. I understand you've launched a company. You're a technology entrepreneur yourself. Why did you think you needed to write about the capital gains tax and that it's not going to destroy entrepreneurship and innovation?
I wrote it mainly because I just felt that the contention that that things were going to get worse in terms of people starting up companies because of this change in the capital gains inclusion rate. It rang so false to me. I could have just kept it to myself, but I typed up my opinion because my LinkedIn feed was full of people saying this is a disaster. And I just felt, okay, here's another take. Why don't you read my thoughts on this as a first person, like a person who's actually started a company. And let's just see if perhaps, there's another way to think of this capital gains inclusion rate increase.
And what's that other way?
Well, again, addressing the concept of, is this going to impact people forming companies, people starting up companies? And I can only speak specifically from the tech sector, right? And the way to think of it is, when a person starts a company, what motivates them to start a company? And it really is, Brian, that they spot a problem and they think that they have a solution to that problem. And ideally, they think that they can get paid for solving that problem. And therefore, they're willing to take additional risks to start a company or to work on that solution and solve that problem. And you'll notice in what I just said, the word taxation did not enter into that equation at all.
What about for the investors that you're going to go pitch to help fund your startup and to take your company further? Are they going to be thinking about the after capital gains tax proceeds they're going to get?
Right. So I do have investors. I have, I guess you could call them angel investors. They're all people that were in my network, people I had worked for, people I had worked with. And speaking for that segment, no, they did not. And I think, we have to look at the people we're talking about, the people we're talking, hey, this is a big problem, or this is going to be a big problem. They're talking about people, it's going to hinder people from starting businesses. Well, when you start a business, nobody is giving you checks of gargantuan size. You are looking for that first level of investment. If you're looking for investment, Brian, I mean, some people are able to bootstrap their companies, right? So you can put aside that consideration. But if you are starting from ground zero, you are looking for investors just to be able to fund taking your idea from an idea into a proof of concept. And you're going to be talking to people about, I have an idea, or I have coded up a product, and here's what it functions like. Those people that you are seeking, you want people who are going to buy into your idea. And you can't put together a cost-benefit analysis based on, I have this idea, I think it will do very well in the market. You can have some idea, here's our total addressable market. But the people who invested in my company did not say, I think we're going to make $1 million off of this, and the capital gains inclusion rate is 50% on that, and therefore I'm going to pay this amount of taxes. No, nobody thought that way. And I can assure you that anybody who is an investor, a prospective investor in a company that is at the pre-revenue or even the seed stage isn't thinking in terms of I'm going to make X hundreds of thousands of dollars from this investment. They're thinking this could go to the moon. I could make it millions of dollars off of this, right? And so they like the whole calculus of like, oh, well, I was going to, if I invest this 50,000, then it will turn into this amount of money and I'll pay this amount of tax on it. No, you're not thinking in terms of that, those types of quantities. And therefore, there's some kind of hurdle rate that you will then have to clear in order to feel that you want to write this check. So at this level, again, talking about business formation, taking people from ideas to products, there is no calculus of, oh, I need to achieve this, clear this hurdle rate in order to write this check.
Okay, well, if what you say is accurate, how come so many prominent venture capitalists and finance people on Bay Street have been complaining about this so vehemently?
Well, I can't speak for them, right? I can only speculate that there is a need for them to say something about something that is that is a tax that is going to, in some ways impact the people that they speak for. But look, I said it in my piece, and it still holds true that if they are concerned about business formation, if they are concerned about people taking ideas into products and then grow those products, then it is a case of investing, irrespective of a potentially 5 to 10% reduction in the capital gain that they may make if that idea comes to fruition and actually they have a liquidity event and an exit of some kind.
Lots of them said that people would relocate, their business opportunities or their investments from Canada to elsewhere. Do you think that might happen?
No. People who want to relocate or people who feel that their best advantage lies with starting up their company or becoming part of the ecosystem in San Francisco, the Bay Area or New York or London, will go and do that, irrespective of the tax rate. My company is a capital markets fintech company. We address the concept of fixed income research and credit analysis. It's a process that's traditionally been quite manual, and we have made it something that is very data and uses machine learning to perform what humans used to do. Our target audience are asset managers, fixed income asset managers. There's 3,000 of them in the United States. There's about 125 in Canada. If I was young, single, didn't have any, family or didn't have a mortgage or things like that, the right thing to do would be to spend as much time as possible in New York, going up and down Manhattan to every asset manager and every hedge fund. Again, I didn't say the word taxable capital gain in that sentence at all. There is just in the United States, in the Bay Area and in New York, there is just a critical mass of potential customers and people who are willing to invest in ideas and in early stage companies that makes it very, very attractive, not the tax rate.
I interviewed the CEO of Xanadu, which is a unicorn private company, potentially going public at over $1 billion US, and specializing in AI. And it was interesting because he said the reasons why he was in Toronto and wanted to stay in Toronto was because, number one, the cost of living, even though we've talked a lot about how high the cost of living in Toronto is, was less than Silicon Valley in New York. Number two, that the academic research and smart people that he can hire from the University of Toronto and Waterloo, et cetera, in technology and AI is better and greater than he would get almost anyone else in North America at a reasonable price, so that he can attract them. And number three, he said that even though New York is bigger, Toronto is the second largest financial capital in North America, and so therefore it's the place that he should be, and New York is an hour or an hour and a half away by flight.
Mhm.
What do you think of those arguments?
Yeah, all of that's true. No question. Look, I started my company in Toronto, right? In an odd kind of way, we benefited from COVID in that, well, everybody was trying to do business, to do outreach and sales via Zoom. So I was able to do that as well. Um, there is a huge amount of talent coming out of those universities you mentioned. And, Toronto is uh, remains quite a good place to start a business. The process of incorporating and starting a business in Ontario is so dead easy that really there are no barriers to entry in that way. And then there are supportive organizations at the municipal, provincial, and federal level who are willing to help, in terms of finding funding. Now, typically you need revenue to be able to find that funding to help you with exports. And so yeah, I agree with that perspective. And another thing I'll add, Brian, is that the costs, as you say, like not just salaries, but we were talking with a company in New York that's kind of similar to us, and we were comparing notes in terms of payroll taxes. In Ontario, the EHT is for a company on your first 1 million of payroll per year is zero. And this founder told me I have to pay 11% of salaries for each of my persons for premiums for healthcare. And she's based in Brooklyn. So there are advantages to incorporating and setting up and staying in Canada. And if you are able to, the ideal scenario is, yeah, you have your dev team in Toronto or environs. And then if you have the capital and the funding, then you go to where your customers are. You go to, the Valley or Boston or Chicago or New York, and you fly in and you do as much time as you can pounding the pavement to find those customers. And as my accountant's MNP told me, you don't sign any contracts there because then you become a US taxpayer. But you can do that. And then you fly home and you run your business from there and your operations from there. So it's definitely doable. Like there's no barriers. And the concept that people are going to leave, I just think is people are going to leave because of the aspects I mentioned, like the ecosystem, as opposed to the taxation rate.
I happen to agree with you, and I think that you're raising a really important point in regards to the ecosystem and also in regards to assistance up front. And that's where I think the issue is far more important. And maybe we can chat a little bit about that after a break. We're going to take a message break. We're going to be back in 2 minutes with Duncan Rowland, who is arguing that the capital gains tax increase isn't the big disaster that so many people are suggesting it is. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Duncan Rowland. He is the CEO and founder of a company by the name of Migrations.ml. It's a solution that streamlines the human workflow and optimizes decision-making in the bond credit analysis and evaluation process in global capital markets. But it sounds perfect for, frankly, the financial sector that we've got in downtown Toronto. He's written an article, an opinion piece in the Globe and Mail recently that the capital gains tax hike that was implemented in the last federal budget isn't the disaster that so many people have argued it is. And so I thought it'd be interesting to reach out to him and find out why. You've got an interesting background. You were the senior director of finance and IT at RBC for 5 years. You were the implementation consultant for 2 years before that. You were vice president North American operations with Razor Risk Technology. Sounds like a fascinating company. For 3 years, principal with Coventry Capital, a director of risk analysis and reporting at the Bank of Montreal for almost 9 years, and for 4 years, manager at Deloitte too. So you've really got quite a background in finance. After such an impressive background in finance and becoming a senior director at Royal Bank for 5 years, why would you risk it all to go out and launch your own business?
Yeah, very good question. And I had this idea, right? You mentioned I worked at Deloitte, so I'm a chartered accountant. I worked at BMO frequently with people who did assessments of companies for both lending, but also for derivative transactions. And I saw their process, and it was quite manual and it was quite subjective. And in around 2016, when I was at RBC, we started experimenting, kind of looking into what is this thing called AI and machine learning. And fortunately, I was brought in to work with some consultants that were brought in by the CFO, and I got to learn just more about, okay, what is machine learning? What's the principle behind it? And I felt that there was a very strong use case for credit research, basically assessing whether a company is a worth lending to, because that's the essence of credit, right? And so the idea took hold, and I felt like this is something that should really work. And I talked to a friend of mine in New York who was an executive with HSBC, and he said, "Look, this is if you're able to tell lenders and asset managers that a company is going to default, and with lead time, then the world will beat a pathway to your door." And I really respected this fellow, and so I thought, okay, that's it. I'm going to do this. And that was in about February 2018. So I went out and incorporated the company, served the rest of the year at RBC, and then I quit in January 2019 and started the company, writing a business plan at my kitchen table, and yeah, just was able to take it from that idea, built a team, supported it with my own funding for a while, raised some money from, as I said, from my network, and we've just been trying to make it work ever since, Brian.
When you did that, did you put together a financial pro forma?
Sure.
What you
Yeah.
think you could make?
Yeah. And anybody will tell you that the top line revenue predictions that you make when you put together, like you're kind of dreaming, right? Like,
So you may have had a high base and low or something like that. You may have had a couple of
sure,
scenarios.
you can try scenarioing it out, but it's very, very difficult to. And one lesson, I mean, we can talk about lessons learned, but certainly one lesson that you'll learn in the journey is that it's one thing for people to say, "This is a great idea. You should try and take this to market," and quite another for people to say, "This is a great idea. I'll pay for it." You know, and so predicting the top line revenue is very, very difficult. The best you can do is kind of talk about, as you say, a range, and then you talk about, and I can credibly keep our expenditures quite low so that you, the investor, will not feel like your money is being wasted. It's being put to use in the most efficient way possible to eventually earn us revenue.
Okay, and that pro forma, that forecast, that it had a couple of different scenarios of revenue, and you say that the revenue was difficult to project, and then you had some expenses. Did you have a bottom line, a net operating income?
Sure. I mean, I again, I'm an accountant, so had 4 years of forecasts based on whole bunches of assumptions, and it was quite detailed. And so, yeah, you try to forecast. Here's when we will turn cash flow positive. Here's when you will start, seeing progress as opposed to just checks, money being written and going out of the house.
Was it pre or post tax? Did you have a tax line in that projection?
No, no. I mean, when you don't make any money, you don't have any taxes, right? And
But you
so,
made money long term.
yeah, but again, if you've
You didn't
got
have a tax line in there.
no, you've got carry forwards like crazy that are going to offset that. And
Okay.
then you've got SHRED, or sorry, the scientific research and experimental development credits. So, you to try and forecast a tax rate, especially when you're just starting out, like it doesn't really matter.
Okay. So therefore, number one, your biggest issue was the taxation or the money back from the federal government and provincial government in regards to carry forwards and shreds. Number two, you only had income pre-tax projected in the out years. You didn't take into account tax, but if you did, you would take into account the corporate tax rate.
Yeah.
which you didn't take into account. And then if you actually had someone exit or sell their shares, they would pay capital gains tax after that. Did you take into account capital gains tax?
No.
So I've seen hundreds of pro formas, like you probably have. I've seen people put in corporate tax rate. There is. So some people will take the projections that you put in and they'll put in a corporate tax rate. I don't think I've ever seen anyone put in the capital gains tax rate
Yeah, because
in their
it's
pro
not
forma.
that's not a function of the company, right? That's a function of the investor. So the investor should, if they're doing their, their analysis, and they might say, okay, I've invested this much, and therefore I'll keep in mind a capital gains inclusion rate. But again, with a company like mine, like if you can't forecast when we're going to start making money, and you can't forecast how much money is exactly going to be made, and you can't forecast how much somebody's going to pay for the company, which is the only way to get a capital gains, income, then there's really no point in putting that in any kind of pro forma statement. And from my perspective, even as an investor, right? If you're investing in my company, you're kind of hoping it's going to go to the moon and you're going to be a billionaire, And at that point, who cares? Like,
So I agree with you, but I guess I'm trying to say I think there's sort of three stages of taxation or
yeah,
credits, the reverse of taxation. The first is sort of the loss making stage, the launch stage,
yeah,
and you've identified tax loss carry forwards as a benefit initially because you're going to incur a whole bunch of expenses and you're going to carry forward those losses and credit them against your income in the first years of income. And one of the strange intuitive things is actually a high tax rate, a high corporate tax rate is actually beneficial to those first couple of years because you're reducing your income by a greater amount of loss carry forwards. The second is incentives like, as you said, the research and development tax credit. In the mining business, there's things called flow through shares. And that is a huge incentive for people to invest in mining because the benefit is that the investor gets to take that loss on their own income right away rather than having to wait until you, the company, can take that loss as a loss carry forward.
right,
Then the second stage is the corporate tax rate. And that's going to be, what every company is going to be paying for a while. And then ultimately, upon ultimate exit, it's the capital gains tax rate. So I guess I intuitively think, the capital gains tax rate is sort of the third level. The first is how beneficial the tax system is to launch. The second is how problematic the tax system is to your ongoing business from a corporate standpoint. And then the third is what about the ultimate exit? So the capital gains tax is like the least important and the farthest away. And so that's one of the reasons why I don't think it's as important as people have been suggesting. And I've always argued that it's a lot of the benefits up front that are critically important to people like you that are launching a business. I was in the biotech pharmaceutical business, and we went to the federal government on numerous occasions and argued we should have flow through shares for biotech and pharmaceutical. Why is it that for some reason the mining business gets flow through shares and we don't? And why is it that at the time real estate companies could get an income trust that could flow through pre-tax earnings or losses to a shareholder, and you couldn't in the biotech or pharmaceutical business? If you got flow through shares where your investors would actually take the money that you spend in your loss making years as a current expense on their income, would you be able to raise more money?
um, probably not. Just the nature of my business. And again, I'm strictly speaking capital markets fintech, right? Um, people don't people don't necessarily understand what we do or why it would be important, and that's a barrier. And so it's hard. It just wouldn't change. I don't think it would move the needle, Brian. um, I do agree that the concept of flow through shares is very effective in drawing investment. um, in the US they have those MLPs that are very, very attractive, but they're attractive in terms of the return. And I think I think it's an interesting idea. But again, like investing in startups and in the tech sector is different from investing in the mining sector. The mining sector, I think there's I don't know the mining sector particularly well, but it's a well-established business in Canada. You've got loads of people who have worked in it, and therefore there's people who have their name has brand value for being able to raise funds. Um, it's not quite the same in the Canadian tech sector, and so I I can't really make a great deal of informed commentary on that, Brian. But to me, like again, just like with capital gains inclusion rate, I've never spent a day with my company thinking if only I had flow through shares, then I could make a greater pitch to someone.
Okay, well, what about the R&D tax credits? You apply for those shreds on a regular
Yeah,
basis?
absolutely.
How important are
Absolutely.
they?
They are very important. Um,
And how do they work? Explain to everyone how they work if you could.
well, colloquially speaking, when you file your corporate tax return, you file a form called a T661 in which you write a very creative essay about the work that you have done that is constitutes research and experimentation for a specific purpose to solve a specific problem. And then you collect all of the eligible expenses and you fill out a series of other schedules. And you ideally will then get, depending on your company size and status and that, somewhere between 20 to 30% of those eligible expenses back as a check. So not even as an offset to your income, but as a genuine, here's money back in your pocket.
So think that frankly, shreds, scientific research, tax credits,
Experimentation, development, yeah.
the way that you describe it, and flow through shares are effectively the same thing. What they're doing is they're giving you a credit on your income tax. One is shreds, the government deciding whether it's a good investment and whether you make sense. And
Mm-hmm.
it's that creative essay that you write. And often you've got to get some external person to comment
Right.
on
Yeah.
how wonderful and creative you are. So it's government knows best versus a flow through share is the market's got to decide, because the difference in a shred versus a flow through share is in a flow through share, what you're doing is you're going to your friends and family and the public marketplace, privately typically, and you're saying, this is a good idea. And if you invest in my company, you're going to get half of it back, or your marginal tax rate back from the federal government. So it's only costing you 50 cents or whatever on every dollar you invest. So it's the marketplace deciding. And I am a firm believer that the marketplace decides better with just judgment after judgment after judgment in the marketplace with smart people than government does with its bureaucracy and regulation. So it's effectively the same as shreds, which you say are critically important, except it's everyone deciding rather than some bureaucrat in Ottawa that goes through and reads your creative essay and decides whether you're right or wrong. Anyway, we can discuss that. But my point is, and your comment about the HST on payroll is so critical. Help in the early stages, I think, is the most important thing that startups need, because that's when you need the help the most. And 10 years from now, if you're going to pay 8% more in tax on an ultimate exit that you think is going to be $1 billion, and it might be 100 million or it might be $1 million, who knows what, it's not that relevant. And frankly, if you were that important about what your exit would be, you'd probably move to Barbados or Ireland or Bermuda. And you'd have to do that before you knew you were going to become a billionaire, rather than when you're a billionaire, because you'd still pay the tax on exit. But that would be the place to put your asset. So tell us, if you could, about what the day in the life of an entrepreneur is starting a business.
uh, it's rough, quite frankly. But at the same time, it's a real thrill. Especially, in my instance where I worked, for the most part, I worked for, as I said, BMO Capital Markets, RBC Capital Markets. Those are large companies, right? You're a bit of a drone and you're not really in control of your destiny. Whereas you start a business and it's every day is um, every day is important. And the joke I used to tell people after I left RBC was like, I haven't had a useless meeting since I started this company. Um,
And are you
you know,
suggesting in the corporate world you had useless meetings? My gosh, you're kidding.
to be. Um, and you are responsible for every day you wake up and you're responsible for the funding of your company. You're responsible for your employees. Do they understand why they're here? You're responsible for trying to win business. You're responsible for expense management. And all of those things are a ton of work, but it's yours, right? And so it is just that incredible feeling of like, if I take these steps, then I will see these changes or these results. And to have that, just that feeling that taking these steps, which I believe are in line with my principles and in line with why I started the company, that they will have this impact, like is very, very invigorating, let's say, right? So, sorry, that doesn't really describe a typical day, but a typical day is like you get up and you look at your bank account, you look at, your talk to your employees. If it's a tech company, you're going to have your stand-up meeting to make sure everybody's aligned. And you're going to look at, we use a product called Jira to track the development, the coding and rollout of the products. And then you're going to look at, okay, what's my strategy for building sales? Where am I with that? How do I break down that strategy into a series of tactics and how am I tracking with those? And that goes on and on and on. And it's relentless. But it's, like I said, it's just that feeling of like, I really, really believe in what I'm doing, and I believe in the steps that I'm taking. And I have this great network of people that I can consult with when I don't feel like I know what I'm doing. And it is, as I say, it's very invigorating. It just answers that whole question. Why am I here?
How much of your time do you spend raising money?
Nowadays, very, very little. There were phases. So I started the company in 2019. There were phases in 2019 when I was trying to raise, from the family and friends group. Probably in those, let's just say that like there was like this 2-month phase when I was really, really pounding the pavement trying to talk to people who worked for me or used to work with me and so on. That would be about 50% of my day for that phase. And then you got product rollout, right? And so everything kind of drops in priority. But once we started earning money, like, earning revenue, the goal then was to continue to earn revenue and increase the revenues to fund yourself out of operations. The
Organic
best,
growth.
pardon me?
Organic growth.
Yeah, the best source of funding is revenue. Full stop.
No
If
question.
you if you can avoid having a VC looking over your shoulder all the time, you should pursue that strategy.
But I do think most people in your situation tell me, at least I think, that they spend an inordinate amount of time pounding the pavement trying to raise money, and that's one of the biggest challenges. And it's the money up front that they have the biggest challenges raising. I
Absolutely.
think that it's interesting to talk about what government and the local market, the ecosystem, can provide to you as what are the critical factors to success in entrepreneurship. And maybe we can take a break for some messages and come back and ask you that, because again, I think capital gains, it's an issue, but it's not nearly as important as a whole bunch of other issues. And let's chat about that if we could in 2 minutes when we're
Sure.
back with Duncan Rowland. Stay with me, everyone. 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. The federal government came out with an increase in the capital gains tax rate, inclusion rate. It's a confusing thing. Some people don't understand it. They went from 50% to 66 and a third percent. People think that's the tax rate. That's not. That's the inclusion rate. And so it effectively takes the tax rate from about 25% to 33%. So it's about an 8% increase in the marginal tax rate for the highest income earners of what you pay on a capital gains. And at the same time, you still get a fairly sizable chunk of lifetime earnings of capital gains that you have as a deduction. And so, frankly, the federal government doesn't think this is going to impact many people. It's like, not 1%. It's like 0.1% of the people that are going to be negatively impacted by this increase in capital gains tax rate. Duncan Rowland, who is the founder and CEO of a fascinating financial technology company called Migrations.ml, wrote an opinion piece in the Globe and Mail that said that it's not as big an issue as everyone thought it was, and so I thought it would be helpful to chat with him. And thank you for joining us. Let's take a second, if you could, and explain, if we can, a little bit better what exactly your company does. You said it uses machine learning, which is a fancy word for artificial intelligence, I think. And you're producing fixed income analytics. So you're looking at fixed income would be bonds, I think. And so government bonds and what bonds from corporations and things like this. And you're analyzing them for asset managers and clients. So is this really a computer that's analyzing the credit worthiness of the federal government, the Ontario government, and different companies?
Yes, but we don't. So we don't analyze the federal government. We do produce analytics for the provinces, but otherwise we focus on the corporate bond market, which is quite a sizable market in both the U.S. and Canada. So we produce a set of well-known analytics that are very traditional in the fixed income investment market. We produce them, as you say, using a machine learning algorithm. Machine learning is a subset of artificial intelligence. We produce them daily for over 1,000 companies and the 10 provinces. And we produce them, what gets produced are a series of quantitative figures that describe the creditworthiness or the credit risk of those corporate bond issuers. And normally that type of work is done by humans. They would look at the financial statements of a company. They would then consider the macroeconomic environment and the market that issuer is in, mining, transportation, financial. And they would produce the best known credit research companies, Moody's and S&P and Fitch, and that they produce an alphabet soup of letters to describe the credit worthiness. And that figure gets changed maybe every quarter, usually, it gets reviewed every quarter, sometimes even only annually. And the fact that it's a combination of letters and numbers means that it's not a quantitative data series like equity prices or foreign exchange rates. And so what we try to do is transform that into a quantitative data series, which can then be analyzed itself. And you can form a time series of our data, and you can look at it cross-sectionally. The point was to transform credit worthiness from a qualitative expression of risk into a number. And that number, as you know today, it's all about quantitative data. And
so that number is what, a 1, 2, 3, 4, or a percentage, or what?
Right. So one of the basic figure we produce is a probability of default figure, which is again, it's a well-known expression of creditworthiness, but it's a percent figure. I mean, nowadays you just express it as 0.01, for example. And then we're able to transform those into credit spreads. And credit spreads are the tradable data series that the bond traders that you see on TV, or that they use when they are making judgments about whether they want to buy or sell something.
So I'm doing a financing right now, and I had DBRS come to the facility and walk around and ask a bunch of questions and take a bunch of pictures. And I don't know what they're going to do. And there was no quantitative analysis in that. It was a bunch of, I presume, qualitative perceptions as they were walking around. Which is better, your quantitative analysis or that qualitative review? And don't you need some qualitative review?
Yeah, for sure. We don't walk into a room and say, see all those credit analysts, we're going to replace them, right? There is always a need for human judgment and human assessment. However, the ability to transform something from a qualitative assessment into a number is just very, very valuable. I can assure you that if you have a team of credit analysts or credit researchers, that Dave over there is going to have a different opinion of a company from Jane, who sits next to him. Well, what happens if Dave leaves the company and Jane starts covering that company? Well, then suddenly you have this disjoint in terms of the assessment of that company. Whereas if you have an objective number, then you have a time series that I think has a lot more consistency to it and doesn't reflect, prejudices or just a person's how bad a day a person had when they were writing up their report. So yeah, it's a good supplemental to traditional credit analysis. But just one last thing is that we've seen empirical evidence that artificial intelligence does a much better job of than humans in all sorts of areas. So medical assessments, right? Of even of X-rays or CAT scans, and then virtually all equity trading and all FX trading these days is done through algorithms, and
So
they wouldn't be like that.
number one, this is fascinating, and I'd love it if I could get exposed to your company and some of the analysis. But number two, let me ask you to take a big, huge, giant step back. The
Mm-hmm.
federal government, the provincial government, just the other day announced, I don't know what it was, a huge $1 billion plus investment in EV battery plants and EV electric car manufacturing. And they've done that a couple of times. And they're trying to attract big companies to Ontario to do that because obviously they think that the electric car and the electric battery is an industry of the future. If I happen to believe that actually artificial intelligence and machine learning is one of the biggest technological leaps in the future, and that the Greater Toronto Area has an incredible opportunity to be leading in that area. What would you suggest that we do so that we can actually be that spot, that ecosystem where people like you want to come and launch businesses? What are some of the key things that you would think, the key criteria that you think that we need to have to be the place where smart people like Duncan Rowland want to come and launch businesses?
Um, Hopefully people smarter than Duncan Rowland. But look, the an ecosystem is difficult to create, right? And it is not even you can't create an ecosystem and see the results in 24 months or it takes time. And therefore one of the first things we need, Brian, is patience and then you need a strategy, but this strategy is going to have to cross private sector as well as public sector. And it's difficult. It's difficult to take a private sector in which money is being made and say, you know what, you're going to have to carve off some of that money and invest that in technology and companies that we aren't certain are going to make a profit and are going to make you money. So it's if you were to say, Duncan, you are a king and you're going to do this, it's be it's a very difficult conundrum because you have to be able to get everybody to at least understand that change is coming. AI is going to replace a lot of jobs, but AI is going to create a lot of opportunities. Therefore, you, Mr. CEO or Mrs. CEO, need to think about how is your business threatened and how can you take advantage of this opportunity, and then think about that in the wider context of there and what is available in Toronto, Ontario, and Canada to be able to take advantage of that opportunity. It's hard to take a CEO and tell them to start thinking about the future beyond when they're the CEO, right? And that's that's a difficult that's a difficult problem, Brian. And I think that is the biggest challenge that Canada has, is that there really isn't a roadmap for Canada per se. There is a roadmap, in the Bay Area or in Manhattan because they've seen it and they've done it. But Canada has never created an ecosystem of like, we have this pool of money and it is going to be married to these very bright people and they are going to be able to create companies. Some of them are going to fail, but some of them are going to become world beaters. And those people are going to then spin off and start their own companies. So, uh, it's just a very, very difficult situation. And it's going to require just a ton of patience and understanding. And I would think, and I'll let you speak in a second, Brian, but I would think that it therefore requires a lot of communication and a lot of you're going to need people who people respect and are willing to believe in, and those people are going to have to get out there and talk a lot about here's how the future can work, and here's why it would be good for everybody. Um, I haven't seen anybody step up at the moment to do that.
So I think that there is a roadmap, and I think these super clusters that the federal government are currently launching and backing are part of that roadmap. I do think that Silicon Valley has been the roadmap, and I think there's a couple of things that you know we've learned about cluster development, about ecosystems, et cetera, that are key. People forget that a lot of the start of what happened in Silicon Valley was defense spending after World War II. And so government plays a very critically important role in starting technology by investing some of the public purse in some things. The role of Stanford and Berkeley, I think, is key. And so therefore having educational institutions that have got really good, technology development, engineering, science, et cetera. And then also making sure that that technology can get from the university out into the private sector, I think is key. Then what you need is you need people to fund it. And so I think that, the venture capital business that grew up in the Bay Area, and I've gone, as you probably have, and tried to pitch people in the Bay Area. And you can walk down a couple of streets and go door after door after door, office after office, and pitch different VCs. So there is a nucleus of a bunch of people that are there, smart and with money, that are constantly looking at opportunities. But you can't do that first. That's got to come after, because it's got to the ecosystem's got to exist to start with. One of the things that started in Silicon Valley that then frankly happened in Manhattan, which is a little bit counterintuitive, but it's cheap space. So Silicon Valley at one point in time actually had cheap space so that people could launch technology cheaper. And then a lot of it went to Boston, in the old warehouse industrial area, and Manhattan in southern Manhattan, where there was cheap space, surprisingly enough, so that people could launch businesses. And we tried that with Mars, thought that would be cheap space, and it ended up being really expensive space, so it didn't sort of work. But you need sort of cheap space. And in the end, I think you need to have this ecosystem, because the reality is, and you mentioned it a couple of times, you got to talk to people. You got to communicate. You got to, and they, you go back to that Austrian economist who talked about there's something in the air. It's synchronicity. It's serendipity. It's that you bump into someone that says, I got a good way to do blah, blah, blah. And some of it is stealing ideas from other people, or borrowing ideas from other people, or getting, employees from other people. And you create an ecosystem. You create a culture. And then I think the last thing you mentioned I think is really key, is you got to have a couple of champions. And having those people, and whether it's the example of Xanadu that goes public at over $1 billion US, or it's you that goes on the Globe and Mail, you got to have some people that are willing to step up and say, this can be the center of a ecosystem. It was probably, in Waterloo, BlackBerry, Jim Basile, and people that created a lot of the image around what was happening there. So I do think we have some roadmaps, some examples, and we've got an opportunity, I firmly believe, to create that kind of an ecosystem in the Greater Toronto Area. I don't think we're doing it, and I worry that we're focused on the wrong thing with this capital gains. And I hope people like you can stand forward and start talking about what those things are that we need. And I happen to believe flow-through shares would be really beneficial. So I'll have another discussion with you, because you could be helpful in that regard. What do you think of that recipe?
Yeah, it makes a great deal of sense, and it's Senator Colin Deacon wrote a LinkedIn post recently, and he talked about the need for the transmission. The engine is as you talked about Waterloo and the engineering schools at U of T and so on. It's the transmission. In my opinion, Brian, that transmission is the private sector, and I don't know how to motivate the private sector to confront, what I talked about, it's sometimes called the innovator's dilemma of, you're going to have to carve out some of your expected earnings today to be able to invest in things, and some of those aren't going to succeed, but some of them are going to succeed spectacularly. So it's, there's a reason why I'm slightly at loss for words, because it's a difficult challenge.
It is, no question.
And I haven't heard, I think that, I just think that the champion hasn't emerged. And it's a difficult era for a champion to emerge because there's a lot of an opinion can get expressed very quickly and get amplified very, very quickly. And I worry that a champion could quickly be shouted down or brought to heel or the tall poppy cut down rather quickly.
We do
Uh,
that too often in Canada, don't we?
yeah, it's not just a Canadian thing, but yes, we do that in Canada quite a bit. There's a huge amount of, oh, we're not good enough. We're not as good as the Americans, therefore why bother trying? Which is kind of an annoying thing to hear.
Well,
Um,
Duncan, I think you've done a good job with your article, and thank you for joining us today. I appreciate it.
yeah, my pleasure. It was great
If people
speaking.
want to check out your company and follow your progress, how can they best do that? Is there a website that they should go to, or LinkedIn or Twitter or anything?
Migrations.ml is the website. We have a nice 3-minute video that explains what our product does. I am on LinkedIn. Migrations.ml is on LinkedIn. And that's probably the best way to follow my opinion pieces. I mostly talk about credit and private credit as opposed to taxable capital gains. But that's the best way to reach out and engage with me.
Duncan Rowland, thank you so much for joining us. Really appreciate it.
Yeah, my pleasure. Thanks,
We're going to
Brian.
take a break, and I'm going to come back with a few concluding comments in just 2 minutes. Stay with us, everyone. Duncan, really appreciate your comments.